Okay, so Assalamu alaikum, welcome back. In the previous video, we uh, saw the recognition part. What are the considerations for recognizing the Ijarah asset by the lessee? So we discussed the package recognition, we discussed the time period for recognition, and also we discussed um, how to recognize what's the difference between recognition in terms of lessee and lessor, that the lessor has to decompose the package into Ijarah and non-Ijarah item, but the lessee has an option to combine them. Now, coming on to the measurement side, right? So how do we measure? So the first thing on the asset side, the lessee, the accounting for the lessee. So the right of use asset has to be increased, has to be debited by the prime cost of the asset, right? So prime cost of the asset means if the financial institution from which the asset is being leased has especially procured that asset, then whatever is the cost, which is the procurement cost or the procurement cost, plus the initial direct cost, which are either borne by the lessee or borne by the lessor. So these will be capitalized. So if I take a lease machine on lease, um, whatever are the lease terms, whatever is the total payment, but the asset has to be debited at either the purchase cost or the fair value, right? So cost of purchase, or if it is not available, then the fair value of the asset minus expected terminal value. Why expected terminal value has to be deducted? Because in most of the cases, the asset is not belong to us, so it has gone back to the lessee. Plus any indirect initial direct cost which we have incurred or banks have incurred, plus dismantling cost. Now this is something which is the requirement of the property plant and equipment accounting standard in IS 16 and IFRS regime as well. So that has been actually reproduced here. That says that if you install a factory and it is known for especially for oil business, oil refineries. This is something which is very much, I think, relevant. So when down the line you wind it up, then dismantling the factory would require huge expenditure just to keep the venue, the property, the earth usable further. So that's the cost. This is the type of the dismantling cost which are not incurred, that are future cost, which will be definitely incurred if you install that factory. You have to, it's a legal requirement. So what we do, we also bring them into cost calculation, the present value of them. So we keep the present value of these deferred costs, put them in the cost of the right of use asset over here, and of course there is a subsequent liability as well, which is the dismantling cost payable, which will be paid after the expiry of the asset life. So this is usually the total cost at which the asset has to be recorded. Now the liability, now there is one important thing, is use underlying asset cost method. So this is all the cost method. Preferably use liability method if the cost is unknown. Sometimes the cost of the asset is not known. So then it says that you have to use the liability method. It means now the value of the asset will be derived from the value of how much I'm going to pay for lease, right? And then present value of those payments. So for example, if the asset value is not very much clear, but I know that I have to pay 100 rupees per month for a period of 5 years, it means 1200 multiplied by 5. So I have to pay 6000 rupees, for example. So now 6000 rupees, this liability will be basis for measuring the cost of the asset. So what I will do, I will keep it as an annuity of 100 rupees for a period of 60 periods, work out the present value and record the right of use asset. So how the liability is to be recorded? So there is a gross Ijarah liability, which is the total fixed rentals, 100 multiplied by 12 multiplied by 5 in this particular example that I just gave. Let me get some pen, for example. So it's the fixed rentals, right? Plus it has to be some variable rentals. Variable rentals means those that are linked to indexes, etc., or sometimes that is linked to some usage. So that also has to be estimated, plus the terminal penalties, right? And these will be taken into consideration only in case we intend to terminate it. If we do not intend to terminate it, then of course, again, we have discussed it earlier that a stochastic probabilistic calculation has to be made, that what is the most likely scenario. So this will constitute my total gross liability. Of course, my total gross asset is not equal to my total gross liability. So let's do it to lesser pointer. So the difference of the liability and the asset, the cost of the asset will be lower than the liability because it is deferred payment. So of course the bank is charging something more than the cost. So that has to be recorded as a deferred Ijara cost, which is a contra liability account. So eventually, the net liability, net Ijara liability, is the gross liability minus the deferred Ijara cost. How do we work out the deferred Ijara cost? Is the difference between this and this simply. So in nutshell, the asset will be debited at fair value and plus the direct cost, and the liability also will be equally credited at fair value of the asset. That's the present value of the liability, most likely the case. So this means that this is what we do in the traditional conventional lease accounting as well. In the conventional lease accounting also, we record the present value of lease liability or the fair value of the asset, whichever is lower, as the basis for accounting, and then periodically the liability increases, right? Because we pay interest, liability decreases, sorry. So we pay interest plus we pay some amount of liability. So eventually, every installment that we pay as rent has some sort of interest, conventional lease, right? And some portion of liability, and the liability gradually decreases. Over here, everything that we pay will have some sort of deferred cost amortization and some sort of Ijara liability. So if I pay 100 rupees rent, then out of 100 rupees, some Ijara liability will be amortized and some gross liability will be, some deferred cost will be amortized and some gross liability will be amortized. So this way, the accounting takes place. So advance rentals paid before commencement are netted off the gross Ijara liability once the term begins. So we shall do some example before we move forward. Assalamu alaikum friends. So here is the scenario to reflect on the treatment by lessee. So an Islamic financial institution acquires specialized medical equipment for $100,000 and enters into a 5-year Ijarah Muntahina Bitamlik with a hospital lessee. So the cost of the asset is known, 100,000. This is the fair value of the asset. Ijara term is 5 years. Annual rental is agreed as 25,000. So 5 years into 25,000 is 125,000. This is the total liability. So implicit rate of return. So if we keep this as present value and 25,000 annuity, the present value of a 25,000 annuity end of year comes out to be 7.93% IRR, internal rate of return, right? So this can be worked out from the financial calculator, but usually in the accounting, it is given to us, right? So the internal rate of return is 7.93%. So how do we initially recognize the lessee side? So the requirement for recognition of the right of use asset was cost plus direct fair value, or the cost of asset plus direct cost. There is no direct cost involved over here. Had there been some direct cost, we could have added it to this $100,000. If this $100,000 is not there, right, then what would we have done? We have taken this $125,000 as the basis, and we would have done the reverse engineering to work out the cost of the asset. So we would have used the market rate of return, say 8%, 9%, and reversed it, worked out the present value, 25,000 annuity for 5 years, and we could find 90,000 or somewhere around this as the cost of the asset. So this is not preferred, but if the fair value or the purchase price is not available, then this is the only way out. So the right of use asset has been recorded at the prime cost, 100,000. The gross Ijara liability is 125,000. So the deferred Ijara cost is this minus this, which is 25,000, which is a contra liability account. So how do we record it in accounting terms? Asset increased by 100,000. Gross liability increased by 125,000, and a contra liability, which is again on the debit side, a liability decreased by 25,000, which is the deferred Ijara cost. So this is at the time of recognition. Now we shall see further that how do we account for subsequent measurement in respect of the asset as well as that of the liability. Okay, so having done this, now what happens subsequently? So for the subsequent measurement, what we do with the right of use asset, we depreciate the right of use asset. The right term used in the FS accounting standard 32 is actually amortization, because this is a sort of an intangible asset. This is a right, so we amortize it. Physically, asset does not belong to us. So usually the amortization, if it is on the straight line basis, although it can be on some other basis as well, but if it is on the straight line basis, then it would over a period of 5 years it would become zero, or it would be equal to the residual value. Now the liability would fall not on the straight line basis, right, but it would fall in a different pattern. So for example, when we will pay first 25,000, right, we will see in the example as well, uh, then a major portion of that 25,000 uh, would be the finance cost from the conventional lease perspective, and a lesser portion will be liability initially. So a major portion will be amortization of deferred liability, and a minor portion will be that of the liability. So we will see these calculations. But the point is that again, this presentation, this slide has been developed by Notebook LM, and I doubt this is the wrong slope of the liability. Liability won't decrease this way; it would have decreased rather in a convex manner. I'm not sure. So I doubt that this is not the right plotting of the curvature of the liability. That reflects the payments made minus the amortization of deferred Ijarah cost, because this is the net liability. So we will see first, and then we will also try to plot. We can plot and check. Let's move forward. Okay. So then there are handling modification and exemptions further. So it's not covered for us. Advanced level discussion and financial statement architecture, lessee perspective. So first let's go through the example. So here is example we were continuing with, right? So subsequent measurement. So now we do what we do with the right of use asset. So we amortize it. There was a 5-year life, and assuming that the residual value will be zero, so the amortization is 100,000 divided by 5, 20,000 per year. So we will record amortization expense, and we will credit the accumulated amortization on ROU asset, which is actually reducing the value of asset. It's just the contra asset that reduce the value of the amortization asset. So on one hand, we record the reduction in owner's equity by means of an expense, and on the left hand side we reduce the asset by means of a contra asset, so we reduce the value of the asset. So on the liability side, on the settlement of the liability side, of course we pay 25,000, so gross Ijarah liability 25,000 debit and cash credit, so asset decreases, gross liability decreases, but at the same time now we also have to account for the amortization of the deferred Ijarah cost. So the deferred Ijarah cost was actually 25,000, right? So how much of the deferred Ijarah cost has to be amortized? It's not on a straight line basis. It is to be on the effective profit rate or effective interest rate basis. So the net liability was 100,000. So the interest expense, or the finance cost, not interest expense, the finance cost, the time value of money cost associated with this for the first year is this into 7.93, so 7930. It means initially we need to amortize 7930 of the deferred amortization cost. So we amortization of deferred Ijarah cost, which is an expense, and we credit because the amortization is a debit balance, right? On the other end, on the liability side also, it is a contra liability. So we credit deferred Ijarah cost, so it reduces, right? So liability reduces by 25,000, contra liability reduces by 7930. So what happens next now? So our right of use asset, right, end of year balance is 80,000. Our gross liability end of year balance is now 100,000. 25,000 is decreased. Deferred Ijarah cost 7930 we have amortized, so is 17070. It means our net liability is 8292930. It means next year deferred Ijarah cost amortization will be worked out on this amount. Keep in mind that 7.93% was actually applied on the net Ijarah liability. So next year this 7.93% will be applied on this. So of course the amortization part will decrease and the liability part will increase, right? So anyway, why? So we don't need to discuss this concave, because I was actually in conversation with this notebook LLM that the curve, the concavity and convexity of the curve is something in question that I also mentioned to you as well. So finally, when the asset will be transferred after some period of time, So that will be separate contract, and of course it won't be come under the Ijarah accounting, but whatever will be the residual value of the asset, if we pay for it, we record it at the amount we pay, and if it is gifted, then automatically it is recorded at a nominal amount of 1 rupee, because we have depreciated the entire asset. So coming back to the presentation, so coming here, so what towards the end of the period, we have to show the right of use asset as an intangible asset, right? But separately from other intangible asset. On the liability side, we have to show the gross Ijarah liability minus the unamortized deferred Ijarah cost, so it will be the net Ijarah liability. On the income statement side, we have to report the Ijarah cost. So what are the costs associated with Ijarah? Number one is the amortization of asset and amortization of deferred cost. So these are the two main expenses, 7931 and 20,000 in our example case. And if there are some variable rentals or gain or loss on modification, something like this, then these are also to be reported. Now, what are the disclosures for lessee? Breakdown of combined asset. If there is uh, 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 a sort of a Ijarah muntahiya bitamlik, then how much portion, again, if it is a gradual transfer, how much portion is owned by me at the end of the year, and how much portion is owned by the financer. So maturity analysis of the liabilities, right? The periodic distribution, the outstanding hamish jadiyya, if there are any security deposits, and charity payments made against default. So if there are any defaults, and how much charity is collected and how much charity is eventually dispersed to the rightful channels. So that is the accounting for the lessee. Now in the next video we shall see the measurement especially and the accounting for the lessor. We will continue with the same example. Thank you.